Hello, this is Charting Man Dan of TheChartGuys, where we teach the little guy and girl how to utilize charts to manage their own trades and investments. What do I mean by the little guy and girl? Well, we just had two directives signed halting the implementation of a rule that requires financial advisors to act in the best interests of their client. Let that sink in a little bit. The big wigs on Wall Street can play with your retirement and hard-earned money without your best interests at heart. We currently have hundreds of members taking charge of their financial future, and we would love for you to come check out a free week with no credit card required to see if our services would be beneficial on your path to financial independence as well. What we offer, we have a separate course of over 5 hours in length on when to enter and exit positions. And in terms of what we do daily, we have nightly videos, key levels updated each morning before the bell, 2.5 hours of live daily webcam coverage in the morning and in the afternoon, and over 7 hours of educational videos. All of these links can be found in the description of this video. Come check us out. Thanks for watching. Let's get on to the technical analysis. Hey everyone, checking in on gold, the dollar, and the miners. It was a pretty uneventful day on Friday for both the dollar and gold, but there was a lot more trading opportunity in those miners. And that is the good thing about having these miners and being familiar with them. When we have days like Thursday and Friday where there isn't a ton of market volatility nor opportunity, it is a good idea to be able to look in the other direction because there was certainly plenty of trading opportunity in these volatile miners. So what I feel has been happening, just a little bit of personal opinion, the break in the correlation between gold and the miners preceding the FOMC and now following the FOMC, as gold has still been holding up just fine, but the past 2 days, the miners had pulled back pretty significantly. In my opinion, the break in this correlation is mostly due to the increase in volume and activity and interest in retail traders and in institutional traders, whoever it is, but the influx in dollar volume. And we're seeing a lot greater of supply and demand for shares going back and forth, a lot more dollar volume, and that is breaking the correlation that we are used to seeing. So as I've said in other videos, if gold is trading flat and we have someone looking to sell 1 million shares of JNUG, obviously we're not going to be able to see the JNUG remain flat with gold, as that is going to be a lot more supply of shares than demand, and it's going to drive the price to the downside. So I think the market environment of these miners in themselves as trading vehicles is definitely breaking the correlation due to that high volume and high interest. And people know that the miners are going to see pretty much the most opportunity for trading with the FOMC reaction. So in the week leading up to it, we started to see that positioning. And now after that FOMC, we're starting to still see positioning around, and it's led to some selling the past couple of days. So looking at the dollar on the hourly time frame, we didn't have much upside at all. We're still seeing an attempt from a bounce from oversold conditions. And looking on the 4-hour time frame, we can see we're about to get that bullish MACD cross. We're just coming off of the low 30 level. It's still very weak, but we have a nice pattern to be watching first thing Sunday night. We have multiple inside candlesticks on the 4-hour time frame. So the range on the last one was 127 and 137. So very, very tight. And a break is going to indicate the direction of the next 4 hours once we get that first candlestick forming on Sunday night. So that will be worth watching just to see which direction this tightening range breaks. And what these inside candlesticks indicate is a higher low, lower high pattern on the hourly time frame as things get tighter and tighter. So a break and some increase in volatility is likely going to occur before trading begins on Monday morning. And we'll be looking up at resistance, the highest level of this bounce attempt. There's actually 2 levels to be watching. It's 175 resistance, and the next one to be watching is the high of this candlestick up here, and that made it up to 188. Those are 2 clear resistance levels where if the bulls cannot get over those levels, even if we get a bull break here in the short term, that is going to indicate that we are still weak on the dollar if we are unable to break the lower high pattern. So in terms of support, the lowest price we have seen down here is 114. Then we got 100 psychological. And if we lose 100 psychological, we're looking down at this must hold double low, 99.43. That is the line in the sand that the bulls must hold. Otherwise, we're going to see a shift in the longer term pattern, as it will be a low, a lower high, and then a lower low as we shift from higher lows that have been in play for the past 10 months since May. So watching very close, the dollar looking for an oversold bounce to try to play out, bullish reversal candlestick on the daily time frame, but momentum is favoring the bears over the past week. Looking at gold on the daily time frame, so we can see gold is still holding up just fine for the bulls. Inside candlestick compared from Thursday to Friday. And if we look at the hourly time frame, it's nice, healthy consolidation. We had our initial low, and we keep forming higher lows. The bulls are remaining in control. We're seeing a bit of a tightening pattern here as well. And if I were going to be drawing some trend lines, I'd be putting a line right there. It's more of a horizontal line, not much slope there. But in terms of the uptrend support line to hit those higher lows, I would be sticking that right there. So a tightening range in between these two levels, and then we've got a channel to be watching, the low of that initial little consolidation, and the resistance level is again that line that I have just left there, that I had there originally on the daily time frame, which rejected the price, and I had it there because of all the price action between support and resistance of this level in February and early March. So keeping a close eye on that consolidation, which at this time is normal and healthy. If we get a bull break to higher highs over 1233.44, we're looking up at 1236.73 is the next level. That was a high of a little bounce attempt before this big pullback started really getting underway. So if you would look at this chart on gold, and if you were thinking that there'd be normal correlations with the miners, you would say, okay, the miners must be holding up towards the end of the week and seeing some sideways consolidation, but that was not the case. We saw some pullback. It was on decreasing bear volume, granted, so the bulls are liking that fact. The big time bull volume on the FOMC reaction, a little bit of contained consolidation. The senior miners did not see as much downside on Friday as the junior miners did, so it's a much healthier looking consolidation. You can see where we pulled back here, and I'll actually do some comparison on JNUG and NUGT. But as of right now, support is 22.51. Bulls would love to hold that level on Monday, have that be our higher low of support, and head back to the recent high. I'm looking at 23.08 and 23.45 as resistance levels. We did get that bullish MACD cross, and we are still seeing a bullish reversal confirmation candle on the weekly time frame. That hammer, and we're holding the 200-week moving average support 3 weeks in a row. It's a weaker candlestick on JNUG. That pullback the past 2 days, and we'll check that out in just a minute. You can see it here on the junior miners, an increase in bear volume and giving back a lot more of the FOMC day, a lot more of those gains than the senior miners did. So our support here is 35.68 to try and maintain the higher lows. If we cannot hold that level, bulls just want to form a higher low compared to 33.79. And the level for GDX, if we continue to pull back, is going to be 21.26. As long as it's a higher low compared to that level, the bulls will try and see this bounce continue to play out. GDXJ on the weekly time frame, a lot more significant of an upper wick showing profit taking. So we did get followed through from that bullish reversal Dragonfly Doji last week, but we are rejecting from the 50-week resistance. You can see this 50-week acted as, it's actually doing a really nice job here. Look at it act as resistance for 4 weeks back in November. It acted for support for 4 weeks here in January, and now it's back to resistance, and that level is 37.99. So a lot of price action around that moving average tells me to pay attention to it, and right now it's rejecting the price. So let's go over the comparison to JNUG and NUGT, where we had JNUG giving back the low of Friday. We gave back over 2/3 of the bull action on the FOMC day, and we compare that to NUGT, and we only gave back about 1/3. So it is a significant difference in terms of the amount of pullback that we did see. And in my opinion, it's, again, attributed to the interest and the dollar volume. And we're seeing more people interested, more retail traders in JNUG than NUGT, just looking at dollar volume. I did a really rough math to come up with the average, or a very rough estimate of the weekly dollar volume, multiplying shares by really the median price of the week. And for JNUG, it was about $3.5 billion, and for NUGT, it was more around 2. So there is a significant difference in the amount of dollar volume, and that's indicating that we are seeing a lot more shares trading hands back and forth, and the supply and the demand for those shares is dictating the more considerable pullback as there's more supply of those shares, people looking to exit, as JNUG did see a bigger move to the upside on FOMC day in terms of the gains to the upside. So now we're seeing a bit of catching up, giving a little bit more of that back. So as we head into this next week, gold is still extremely strong. The dollar still has a lot of proving to do for those bulls, but the miners are saying, here we go again. We're seeing a lot more weaker action, just like before the FOMC, a lot weaker than gold. So the question is going to be, can the bulls continue to form higher lows and higher highs on the daily time frame as this bounce continues to play out? And if we see that dollar break 99.43 support at any time in the next month, or really any time going forward, that is going to be a sigh of relief for the gold bulls, and we will look for these bull miners to respond accordingly. So thanks again. Hope you have a great rest of your weekend, and we will see you, or James will see you, on Monday.